Hey, party people, Ben from Pivot. And this week's money news in human words is look, there's a fair bit going on. Obviously, quite a lot of turmoil in what's happening in the economy, this ongoing inflation battle, what economies are doing in response, what it means for property market, share market. So there's a little bit to unpack. The first piece that caught my attention last week, and I'm sorry to be the bearer of bad news on this one, but is um, around higher taxes potentially coming in under the Labor government in Australia. Now, this has all come about off the back of some commentary from the Treasurer, Jim Chalmers, who has come out saying that he wants to have, and I quote, a big national conversation about the structural position of the budget and how we fund the things that we value, not just in our economy, but in society. Now, a little bit wordy, a little bit verbose there from the good Dr. Chalmers, but essentially he's saying, like, how are we going to pay for the things that we want? And look, it seems pretty clear that one thing that people are agreed on is that generally the best way, or at least one thing that the government's agreed on, I suppose if you ask individuals, it might be a bit of a different story, but that the best way to pay for things that we want is through taxes. Now, part of why this conversation has come into the spotlight is because of the stage 3 tax cuts that are coming, that I was super pumped about, and I am super pumped about, and I still am holding out hope that that they do come to fruition. But with the significant budget surplus, deficit rather, in Australia, the position that we're in, and with the economic uncertainty, they're talking about the potential for those tax cuts to potentially be scrapped. Now, Labor's been in office for less than 4 months, and I don't know. I think part of me thinks that they're going to be reasonably reluctant to start jacking up taxes, because they do cop a lot of stick from the Liberal Party when it comes to taxes. And whether that's right or wrong, I suppose, is a different question. But perception is reality a fair bit on this one. So adding to this commentary was our Reserve Bank Governor, Philip Lowe, who came out last week and spoke about the fact that even though we've got this 50-year low unemployment rate and the highest terms of trade on record, we've still got this big budget deficit. Now, my take on this is, if you think about the country like a business, that sometimes businesses are profitable, and obviously that's great because, there's profit, and then profit can be reinvested or, used as actual profit. But a lot of people sort of trash talk on a budget deficit, and I think it's important for the government and for the economy to be living in their means. But when we're facing periods like what we saw, record government spending through the GFC, significant increase in that record through the COVID crisis, that the governments are spending money and investing money back into the economy so that the economy continues to grow. And we've seen that, the most recent data just came out and showed that Australians are the wealthiest people in the world. We have the highest median level of wealth per capita of any country around the world. So I think you can certainly, and I could, and anyone could, criticize individual initiatives that the government has undertaken as part of the spending that did end up in us being in deficit. However, on balance, you'd say that spending money is probably better than the alternative, where they don't spend money and then the economy suffers as a result. Now, spending could have potentially been more targeted, but overall, this spending, I think, is good. So the commentary from the Australian Financial Review came out and said that they feel that the shape of this conversation that Dr. Chalmers wants to have is clear. They think that the stage 3 tax cuts will definitely be cancelled. And then to add to that, potentially some tax increases will come. The Guardian came out with some commentary saying that the stage 3 tax cuts are, and I quote here, are a pile of garbage, and everyone knows it, a rotting pile of garbage from the Turnbull-Morrison years that no one is yet willing to throw in the bin. So some pretty harsh words there. But it does highlight the fact that people, as much as they see the expense of these tax cuts, don't want to take the political loss of coming out and saying that they're opposing them. So the tax cuts are legislated. This is essentially the ones that kick in from the 23-24 financial year, where the top, basically anyone earning less than 200 grand is going to only get taxed no more than 30%, which is pretty amazing from a wealth building strategy perspective. And even though those tax cuts are legislated, because Labor does have the majority, they would be able to repeal these. They also say that the Liberals would have some difficulty coming out defending the tax cuts in the position that we're in, because they're trying to win back these seats from the Teal independents, which creates a complicating factor here. So, look, I think overall, frustrating as I'm super pumped. I think that these tax cuts do create a lot of strategic opportunity around tax planning with investments. But it is something that's on the radar. I think that Labor will be a little bit reluctant, so time will tell on this one. And don't mean to start with some bad news on this one, but it seems like they could be under fire. The next piece that I've got is on the interest rates turning around in Australia, which came out off the back of a bunch of research from UBS, who saw that even though the average price of dwellings in New South Wales, so properties in New South Wales, is dropping more than $500 per day in the 3 months to June, that UBS feel that the RBA will come to the rescue if the property market continues to soften. So they showed that through the last 30 years that the Reserve Bank and policymakers have always avoided a hard landing in the housing market. And they saw that if the housing market started to deteriorate too much, then they step in and come to the rescue. They see history repeating in this. They found through this data that during the last 6 property market downturns where the prices went down by more than 2%, the Reserve Bank tended to cut rates after prices had fallen for about 10 months, or when prices had fallen by about 5%. So they said, and through this UBS commentary, that they feel that the RBA potentially won't be as fast to cut rates as quickly this time around, given that the state the economy is in. But they feel that in 2023, so next year, that the RBA will step in if the property market is still softening at that point. They still think that there's going to be a 13% decline in the property market, which will be bigger than any of the other recent downturns. But overall, they do feel that the RBA and policymakers are coming to the rescue. They feel that the inflation is going to peak around 7.5% at the end of this year. So I think that that's a really big key here. Obviously, inflation is the word of the month when it comes to the economy, but potentially some relief not too far away for a lot of mortgage holders. So no doubt they'll be particularly happy about that. Another piece that caught my attention over last week was Cathie Wood versus Ray Dalio, 2 massive investment superstars, both billionaires with very different views of where the share market is going from here. Cathie Wood is the chief investment officer at ARC Investment Management, which is a company that specializes in big bets on technology and innovation. Over the last week, she's been buying up a bunch of stocks in the US, mainly off the back of the big dip that we saw in the share market over there off the back of their inflation data that came out last week. And they're saying that things are going to turn around, or she thinks that things will be turning around more quickly. Her call, though, is clearly a contrarian view, with Ray Dalio coming out saying that he thinks that inflation is still trending up. Ray Dalio, for anyone that doesn't know, is an investment guru. He's been around for decades and decades, and his company, Bridgewater Associates, look after about US $140 billion of funds under management. He says that the reason that he thinks that the share market is still in for a bit of pain ahead is because he thinks that the expectations around inflation are all wrong. He said that the markets are expecting inflation continues at this 2.6% rate, which is sort of in line with the targets of the Federal Reserve in the US and most central banks around the world. But he thinks that it's going to be closer to 4.5% or 5% over the long term. based on just the general economic conditions, and not including the potential for shocks like things wars or geopolitical conflicts in Europe or Asia, or like what we're seeing with the China Taiwan issue. And look, if inflation persists at a higher rate, it means that interest rates will stay higher for longer, and that's going to slow down economic growth because companies are going to be making less money when the interest rates are higher. Ray did come out and say that he feels that it will probably take some time for this to filter through to the economy because of the strong position that economies are in around the world. So for me, we're seeing two obviously clearly opposing views around investment markets. Both of them, though, see good long-term potential in and value in those investments. I think, though, that what people should be prepared for is that, you know, if Mr. Dalio is right and the share market continues to slide, obviously there's a huge opportunity that comes with that for investors to buy in at lower price points to then benefit on the upside. If Kathy Wood is right and we do recover more quickly from here, then there's money to be made as well. So I suppose neither of them are questioning that investing is a smart play. It's just what that looks like over the shorter term. And we know that our ability to predict in the short term is next to impossible. But I think that the opportunity, you know, downturns make millionaires, and this is a time to make money. But you do need to make sure you've got a rock solid strategy in place. And when you are investing, making sure that you've got the ability to hold your investments over the time period that's necessary to get the results, to get the positive returns that you want. On a similar vein, I was looking at another legendary investor last week, Howard Marks, who came out in the news talking about how all of the forecasters have basically got it wrong. Now, he looks after even more money than Ray Dalio, looking after $164 billion through his company, Oak Tree Capital. He said that they basically, obviously they invest a lot of money. They don't make any of their investments based on the macro forecast. So that means that a forecast around the broader economy, like how far inflation would go, or whether there would be a recession, and what they also didn't do was trying to time the market. He said, and I quote, that I think the idea of waiting for the bottom is a terrible idea. He said that he's been buying a bunch of investments over the last little bit. He said he thinks that assets could get cheaper, though, than what they are and what he's just purchased these investments for. And he just said that he'll just buy more in that case. And I think that my take on this is that you can't time the market. Things obviously do change pretty quickly, but when you see a bargain, you should be taking advantage. I think Howard Marks came out saying when things are going well, people don't worry about the downsides and they push into things that they haven't been in before, which I think my take is, if you look at the markets over the last little bit and what we saw investors doing, investor behavior, this massive run in the crypto market. And I've got a good view for crypto over the longer term, but we saw a lot of new time investors come in and start in things that they hadn't done before, and then they got burnt big time as a result. So I think that the lesson that you take from this is that you've got to play a tempered game throughout market conditions and have a clear investment strategy that you can follow when markets are going well and when markets are going poorly. It probably shouldn't necessarily be significantly different. And if you're consistent, then you're going to be in a better position to make money. Now, Marx is talking about the fact that people should be really skeptical about these macro forecasts and, you know, forecasts around what's going on with the economy, broadly what's going on in the share market, because he said that there's so many variables that no one really knows. There's no predicting power model or forecast that's consistently got it right. And particularly the fact that all of these models on what's happening with the economy, what's happening with inflation, what's happening with the share market, they're all based on assumptions, and it can be close to impossible to know what the right assumptions are to predict. He is in agreement with Warren Buffett on this, that says that one of the key things that you need to do to have a good forecast is that something needs to be knowable. And because there's so many different inputs that drive into what happens in the share market or what happens in an economy, that it can be impossible. But his tip and I think it's a really smart one, is that because of this level of variability, instead of looking at these broad macro forecasts, instead you focus on the micro fundamentals. So that means, like, look at the company that you're investing into, or the share market you're investing into, or the property suburb or sector that you're investing into. And if the fundamentals of those stack up, you know that you've got a good investment at the core. And then whatever happens in the macro or the broader economic environment is going to be whatever happens. But you know that you've got a good investment. It's just a matter of waiting till you make the money that you want from it. Talking property now, and we saw some data come out last week showing that luxury properties have been hit hardest by the property market downturn. A guy by the name of Jonathan Kearns, who's the head of domestic markets at the RBA, put out this commentary at this big AFR property conference last week, saying that they've been looking into data from the property market recently, and found a few interesting things in there. He mentioned that houses are more vulnerable to downturns in the property market compared to units. Also, and probably no real surprises here, the areas with more investors tend to be hit harder when interest rates are rising. He also mentioned that the higher end of the property market is more susceptible to downturns, and crunched some of the data from the market over the last 6 months, where he found that the top 25% of properties by value have gone down by 10%, while the bottom 25% are still up by 10%. So if we look at what this all means, I think that looking at the data and findings, that if you're wanting to buy a property now and hoping to pick up a good deal, you could potentially look at the higher end of the property market that's softened more than the broader market. You could also avoid properties at the lower end of the market that haven't really been as impacted by the downturn at this point. But if instead you're looking to buy a property that's going to be more resilient over downturns over the longer term, you want to look for something that meets a criteria of being not in the top 25% of the property market, in areas with lots of homeowners versus investors, and in areas with a lower average mortgage size, because they found that where there are bigger mortgages, that those suburbs tend to get hit harder when rising interest rates are up. Now, they found, and I was looking at this stat that showed that the top end of the property market tends to run up higher when the markets are peaking, but then go down lower when the markets are declining. Whereas in the middle, it's a little bit, the variability is up, and then at the lowest end of the market, we see less run up when the markets are running and less down when the market is going. So I suppose it really goes down to your strategy. And with property, there's a lot of different ways to be right. So for anyone looking at investing, understanding what those different options are and what they mean. For example, you buy a cheaper property, you're probably going to benefit less in the downturns, but you're probably not going to get the same upside when the property market starts running hot. Whereas when you buy at the top end of the property market or the higher end of the property market, you see more run up. But then you're going to cop it more when there's a downturn. Now, as long as you're smart and you know that you've got a good plan, and you can wait, if you're buying an investment property, you wait till a time that makes a lot of sense to sell, then you can profit at the top end of the property market. And seeing your value go down on paper, while that's never a good feeling, does that really impact you that much? So, as I say, a lot of different ways to be right there, but there's some ways make you more money than others. So being across the impacts and those strategies and baking that in is something that's incredibly valuable, particularly given how big property investments actually are. I think a good lesson there. He said that Dr. Kearns came out saying that how long the property interest rate stayed elevated for really does make a big difference for prices. If interest rates increase by a couple of percent and then go back quite quickly, then the dampening effect on property prices could unwind. But if rates were permanently a couple of percent higher, then property values could fall by something like 30%. Now, the RBA obviously want interest rates to go back to normal, because they want properties to grow. They want us to be a wealthier country, but there is obviously a bit of risk there as well. So again, all goes back to the strategy. No really wrong way, but you've got to find the right rate for you. Guys, that's it from me for this week. Plenty happening out there. I hope you found that helpful. I'll catch you on the next one.